Well, how's it going, friends and family? My name is Amos, and I wanted to circle back to my perspective and stance on the food CPG stocks. So when we talk about Hormel, Campbell, General Mills, Conagra Brands, Flowers Foods, and etc. For the longest time, I used to be bullish about the food landscape because I believed that it is an inherent need for human life. So it's at the bottom of the hierarchy of needs, according to Maslow. If you don't have food, you can't exist. And so using that investing thesis, when you look at the grocery store aisles, it's full of these brands' products. And so I put my money where my mouth is, and I invested into them. Reason being is that I applied the principles of value investing, buying a high-quality business operation while they're on a clearance, while they go on a dip. And every single food CPG stock for the past, what would you say, 2.5, 3 years, they're practically at 1 year, 5 year, 10-year lows in terms of their valuation and their stock price. So I bought the dip. But what happened? They continued dipping. And so my whole thing is, if you liked a particular stock when they were at $100 a share and there's red days ahead of them and all of a sudden they're $75 a share, you should be happier because now you can acquire them at $75 a share. So I dollar cost average. But then eventually, instead of being stubborn and being in my own head, I paused and I said, hold on. Why are they going on a sell-off? Not just one brand, but the entire sector across the board. So what I'm about to share with you is a deep dive research that was exclusive for only the Patreon community. It was posted on December 7th, 2025. By the way, joining the Patreon is a fantastic way to support the channel, plus this community, and I would really appreciate it, but it also gives you a glimpse as to what kind of original content is on Patreon that never makes its way on YouTube. This, however, I feel like enough time has passed where I feel like it's okay to share with everyone because my feelings, my thoughts, and my analysis is still coherent, and it's what I believe to this day. And straight from the Patreon blog post, I quote, "After a recent stock deep dive on Mondelez, it made me evaluate the losers in my portfolio. General Mills, PepsiCo, Hormel, etc. Why the heck are they dipping week after week their stock price? Is there something wrong? Is my investing thesis for the food CPG stocks still relevant? I bought the food stocks because they're defensive in nature as people eat to sustain life. Not outperformers by any means, but they should be reliable, right? Unfortunately, most of the food CPG players are seeing reduced gross sales year over year, meaning their revenue is declining, which partly explains the sell-off. So I started to investigate the grocery stocks to see if they're also seeing the same pattern, because food CPG products would be sold at a grocery store. After digging into Albertsons, Sprouts Farmers Market, Weis Markets, and other grocery stocks, things started to click. Customers are shifting toward in-store private label products instead of the national name brands. And that's called private label penetration. Like when you go to the grocery store and you're thinking about getting a can of peanut butter, there's one that's made by Kroger's, and then there's the name brand like Peter Pan, but the Peter Pan is $5.99, whereas the Kroger's is $2.99. A customer that's on a budget, they're going to gravitate towards the generic off-brand 9 out of 10 times. And you might have noticed this yourself when you go shopping at Aldi, Lidl, Costco, Walmart, Target. Nearly every major grocery chain is aggressively vertically integrating their shelves, meaning they're starting their own manufacturing process, distribution networks to get crackers, chips, bread, snacks, whatever it is on the shelves instead of getting a contract with the actual name brand, but to just make it for them and put an off label on it and pay them a lower fee. No, they're starting to do the entire thing top to bottom, and they get to prioritize the grocery shelf space with their own private label stuff front and center. Whereas the name brand stuff is going to be all the way at the bottom or all the way at the top. Out of sight, out of mind for the consumer. Meaning they're either producing their own products or partnering with companies like UNFI and Treehouse. Those are publicly traded stocks that manufacture foods as private label brands for the grocery stores and platforms that can't do it themselves. Meanwhile, the national brands like General Mills, Conagra, Flowers Foods, that are losing revenue year over year. And that's because the consumers are shifting from buying the name brand stuff to the generic stuff. But grocery chains are holding steady. Their numbers look stellar, and it's even increasing. And that's because foot traffic, the amount of people that are going into the grocery stores to buy food, that behavior, it hasn't changed. Actually, the basket size, it changed, and more on that here in a little bit. People are still eating. They're just opting for the cheaper alternatives. And you might say this is not mutually exclusive. But think about it. As a budget-conscious shopper, and you're living paycheck to paycheck, are you really gonna buy 2 boxes of the same cereal flavor, one generic one, and a name brand one from General Mills? No, of course not. When the times are hard, more often than not, you're gonna go with the cheaper option because it's still gonna be food. It might not taste as good, but when it's 20, 30, 40, 50% less than the name brand product, that will be the difference maker. I think some people have loyalty to food brands, so they'll always pay more for the brand they like. But that's slowly becoming a thing of the past for folks under the age of 50. According to surveys and market research, baby boomers are the last generation where they stay loyal to a very particular food brand. If you are around the ages of like 18, 29, or even 41, you don't mind saving a little bit of money going with the generic brand or testing out other brands. I will caveat that by saying when it comes to drinks and beverages, there is a little bit of bias and loyalty. Like you will gravitate towards only Coca-Cola instead of getting RC, Pepsi, or a dollar store product. There is a difference there. That's a different landscape. We're talking about food, not beverages. My thinking is, now I could be wrong, national food CPG brands like Kraft Heinz, by the way, Berkshire Hathaway, they admitted that it was one of their biggest mistakes. Just like investing into the airline stocks. Funny enough, Warren Buffett stepped down and they just went all out into buying Delta Airlines stocks. So yeah, General Mills, Conagra, and others will continue to lose potential sales as consumers opt for the cheaper in-store brand. The old model of manufacturers sending the stuff to the wholesalers and then sending that stuff to the grocers, that distribution network, is becoming outdated. Look at Aldi, Lidl, Trader Joe's, Walmart, Costco, and others. They're prioritizing their own branded stuff across every aisle, not just for food. For example, at Trader Joe's, around 69% of their sales are from their own private label products. When we think about Aldi and Lidl, the discount grocery chains from Germany, about 80% of their sales are from their own private label products. So, who are the winners? This research made me look at grocery stocks in a whole new light. And I now understand why Costco trades at a high premium, because their Kirkland brand is replacing name brands across every aisle. And it's not just Costco. Walmart also belongs in this conversation. We can also invite Target. Private label has higher margins and can directly displace national brands. Because think about it. If you are Walmart or Costco, why would you want to put the name brand cereal on your shelves for you to only make a 2 or 3% margin on that? Whereas if you put the Kirkland branded cereal or granola bars, the margin for that could be 9, 11, or 12% per transaction. Your net income improves by selling your own stuff. Does that make sense? This is why I'm starting to feel that the platform, the place where the products are sold, may be superior to the individual food brands themselves. Yes, many CPG companies still manufacture the private label goods for retailers. They do. And that's why, if you're suspicious as to why it tastes exactly the same, it's because it is the same. It's the exact same thing. The formula might be slightly modified or adjusted, but it's made in the exact same factory for a fraction of the cost. Now here's the thing, for the individual food CPG brands, if instead of putting Cheerios on the label and you put some off-brand label for the grocery store, they earn a lot lower margins and a lot less revenue. As such, Costco might be expensive, but they're still my obvious pick and S-tier winner when it comes to the food landscape. Their membership renewal rate sits at around 90%. Which is insane for any retail business and speaks to how sticky their model is. That said, I still think their current growth doesn't justify the valuation. If Costco were posting 40% year-over-year growth across the board, I just go on to say when I would like to buy into them. And then number 2, who's the second winner in the food landscape? It would be Walmart, because every single year, without fail, since like 2015, or is it like 2016? Something like that, since 10 years, they've been increasing their grocery market share here in the US, and they continue to win more customers with their great value in-store brand. As a matter of fact, at the time of making this post, Walmart had 21% of the grocery market share. So 1 out of 5 people do their grocery shopping at a freaking Walmart. I know, it's pretty crazy. Instead of at Shoppers, Wegmans, Kroger's, Walmart. And at 21%, that puts them in first place in the US. Second place is Kroger. They're also publicly traded, ticker symbol KR, at 8.5% of the grocery market share. Walmart provides cheaper options and they get higher margins while doing it because their supply chain network is best of the best. But I think Amazon has caught up now, so I think it's better and more accurate to say their peers. It's hard to lose with that combination. Just like Costco, I'm not a share owner of Walmart, but I wouldn't mind at $80 a share. And then I said, in third place, hear me out, Amazon, because they own and operate Whole Foods. If the trend towards fresh, organic, and clean eating continues, Whole Foods could be the unexpected dark horse, especially with Amazon's elite supply chain infrastructure behind it. I own Amazon. I don't anymore. I sold at a very fat profit. Pretty happy camper, and I plan on dollar cost averaging after pullbacks at $2.15 or less. Now, after learning about the food landscape, I am skeptical and cautious towards Kroger's, Albertsons, and other grocery chains because they're losing the grocery market share battle every single year. But given the choice, I would go with one of the publicly traded grocery chain stocks rather than my own holdings of General Mills, Conagra, Flowers Foods. And the natural question is why? Because if consumers are pulling back their spending on eating out at a Cheesecake Factory, Chipotle, Cava, Sweet Greens, and others, then they'll be eating in more often, which means they will spend more money grocery shopping. And believe it or not, a lot of the consumers, instead of going to a restaurant or a fast casual restaurant chain, they'll just go to the food court inside of a Walmart or a Costco and just eat the food there. That's a loss leader. They don't really make a profit from selling those rotisserie chickens for $5 or the food court pizza for $9 or $10. They do that, they eat that loss to keep the customers coming in their doors to allow their competition to choke. And while you're in there, you might spend $1,000 buying a dishwashing machine or a TV. That's how they get you, by the way. Now, I agree, this is a silly thesis, but people have to eat, right? Unless we all start doing intermittent fasting and we just start eating one meal a day. Other reasons as to why I'm turning bearish about my holdings in General Mills, PepsiCo, and etc. Number 1, the GLP-1 drugs. It's basically the weight loss products that curb your addiction, that curb your appetite, that stop you from doing your behavior and your actions of stuffing your face, which may be reducing overeating and food addiction, which means lower total food consumption across restaurants and the grocery store aisles. Now, mind you, I posted this in the first week of December, and we're definitely seeing the ramifications and the consequences of the weight loss drugs. Yes, the fat people are eating less. And then number 2, the war on processed foods. For example, San Francisco sued the consumer packaged good businesses, and I think other organizations will follow suit. Case in point, published by The Guardian, San Francisco sues food giants over ultra-processed products. And that's because the city of San Francisco insinuates that a lot of the chronic diseases are linked towards these ultra-processed foods made by Post, Kellogg's, General Mills, PepsiCo, and the list goes on and on. And then number 3, the United States government going to war on food as well, but removing CPG products as authorized purchases for SNAP, WIC, any of those public government subsidies and support programs, food stamps. This certainly won't help grow sales at all. So what am I going to do? I start talking about my game plan and everything. Spoiler alert, if you don't keep up with the Cheese Public Portfolio series, I sold every single one of my food CPG stocks at a loss. It was a very difficult decision because I definitely do think they're not going to just dissolve and disappear. I do think there's a place for them in the food supply chain. I think once inflation comes back down to earth and we're not going through such a difficult economic situation for the masses, like the 80% of the population, I think they will start gravitating towards name brand products. But ultimately for me, I boiled it down to number 1, the opportunity cost. By selling out of the food CPG stocks at a loss, I rolled that capital right on over to stocks such as Microsoft, Google, and Amazon. And to be honest, I would do that again every single day of the week. And then number 2, more importantly, the investing thesis for the landscape changed. So I do need to upload a revised version of my buy and hold forever business operations that are cash producing assets, but also have a durable economic moat, a competitive advantage that keeps them at the top of their game. Sadly, for the individual food brands, I don't see that anymore. And so as a numbers-based value investing type of guy, the numbers are declining. The landscape looks rough. By having my money tied up in these assets that are declining week after week, quarter after quarter, for me, it all added up to the outcome of jumping ship. It always sucks when you have to make that decision to sell at a loss, but sometimes if you jump ship, you might only take a 40% hit rather than being stubborn and waiting for a 100% hit. Obviously, with the individual food stock brands, I don't think they'll go bankrupt outright. Maybe some of them will. But I do think had I just held on, I think it's going to get a lot worse before it flatlines. And then eventually I do think they're going to recover. I don't know if they're going to hit the prices that they hit in the onset of like 2020 or 2021. For them to get back up to those valuations, I'm talking about it might be like a Cisco situation in the dot-com bubble crash in the year 2000. They were at like $78, $80 a share. And for them to hit $80 a share again, it took 26 years. Okay? So thinking about it like that, strategically, I was like, I'm going to sell out of them. But I didn't just hang on to the cash and do nothing. I definitely rolled it on over into new equities. Much happier. And so I guess my revised stance on the food stocks is that when you think about the platform, the distribution network of where customers go, where it's B2C to buy their food consumption, the grocery store chains, including Costco, Walmart, and Target in this conversation, I would also say they have a toll booth advantage because they get to dictate where the food is on the shelves, but they also are in charge of the infrastructure itself. General Mills, Campbell, Hormel, no matter what they do, they don't own a grocery store, let alone at a mass market scale where people can just walk in and buy their stuff. So they're at the mercy of Giant, Wegmans, Safeway, Aldi. You get my drift? So now I'm thinking about the grocery store stocks in an entirely different light. But anyways, I'm rambling now. If you made it to the end of the video, please would you consider joining the Patreon community? It would mean a lot to me. Please. It's a great way to support the channel, and you get exclusive deep dive research on there, including my stock trades and transactions way before the YouTube community finds out, but also the buying opportunities and the exact price points of which I would open a position. Okay, I'm sorry for telling you about Patreon twice. I suppose if you made it to this point, you probably don't want to. I don't want to push it any further. So I love you guys. Stay safe. Good luck in the stock market. And it's okay to admit when things are not going according to plan. Like for me, I don't ever want to come across as if I'm a wizard with a crystal ball and I know everything. I don't. I make mistakes. I have a ton of regrets in my past. This is an example of where I lost a lot of money on General Mills, Flowers Foods, and etc. But the best part is about life, we can live and learn from those mistakes so we can apply it going forward to be better and smarter and wiser investors. And so for me, I learned when it comes to value investing, just because an entire sector goes on a sell-off, it does not necessarily mean it's a sector rotation. Sometimes the landscape and the parameters of success for those individual brands have changed. And it just goes to show that you should never aimlessly, blindly buy the dip. Always do your research to figure out why are they going into the red 20, 30, 40%, just like the software stocks. I uploaded a video, a couple months ago, talking about how when the entire neighborhood goes on sale, why go for the shed that's on the corner with mold on the walls, with the infrastructure and flooring that's really ratchet, when you can get the mansion, if they're all going 40, 50% into the red, why go for the shed when you can get the mansion that's also 50% off, right? A lot of the content creators, YouTubers, people on Twitter, Reddit, they were hyping up Adobe, Intuit, Duolingo. And I kept saying, guys, these are in the tier 4, the ones that are most vulnerable, the ones that are going to be absolutely disrupted by AI. Don't look here. Instead, look at tier 1, tier 2. I kept saying that, and people kept saying that I'm a doomsday sayer, I'm a negative Nancy, I'm stupid, I don't know what I'm talking about. Some people even gave me threats. They're calling me a pencil neck, and I have a punchable face. And I'm like, brother, I'm just trying to warn you. Okay, at this point, I gotta get out of here. I'm rambling. See ya!